Before we dive in, please remember that I am not a licensed financial advisor, and this video is for educational and informational purposes only. The information provided is not intended as financial, legal, or tax advice. You should always consult with a qualified professional for advice tailored to your individual situation. Okay, let's try a little thought experiment. I want you to picture the single most stressful financial moment you've ever had. Maybe it was seeing a medical bill that looked more like a phone number. Maybe it was that sinking feeling when the mechanic tells you your car's transmission is shot. Or maybe it was just standing at the grocery store checkout, praying your card doesn't get declined. We've all been there. That jolt of anxiety, that knot in your stomach. It's awful. Now, I want you to multiply that feeling by 1,000. Imagine your family at the worst possible moment of their lives, having to face that kind of financial panic, but without you there to help solve it. Imagine your partner, overwhelmed with grief, suddenly having to figure out how to pay the mortgage next month, how to cover the car payments, how to keep the lights on and put food on the table for your kids, all on a single income, or maybe no income at all. That is a nightmare scenario. And it is the single solitary nightmare that life insurance was invented to prevent. This isn't a fun topic. I get it. Nobody wants to think about a time when they're not around. It's uncomfortable, feels morbid, and the industry has made it feel incredibly complicated, full of confusing jargon and pushy salespeople. But here's my promise to you. By the end of this video, all of that confusion is going to disappear. We are going to pull back the curtain and demystify life insurance completely. You will understand in simple, plain English what it is, how it actually works, the main types you need to know about, and how to start thinking about whether it's right for you. We're going to cut through the noise, debunk the myths like it's way too expensive, or I'm too young and healthy to need it, and give you the confidence to make an informed decision for the people you love. This isn't a sales pitch. This is a roadmap. So, what is life insurance at its absolute core? Forget all the complex terms for a second. At its heart, a life insurance policy is a formal promise. It's a contract between you and an insurance company. The deal is simple. You agree to pay a certain amount of money on a regular basis. This is called the premium. In exchange for your payments, the insurance company promises that if you pass away while the policy is active, they will pay a large, lump sum, and almost always tax-free amount of cash to the person or people you've chosen. This payout is called the death benefit. That's it. That's the entire engine. You pay a little, they promise to pay a lot if the unthinkable happens. Think of it like a financial safety net stretched out underneath your family. As long as you're here, your income, your support, your presence is the ground they stand on. But if you were to suddenly fall, that safety net is there to catch them, to prevent a financial catastrophe on top of an emotional one. To make this crystal clear, let's quickly define the four main characters in this story. First, you have the insurance company. This is the big business, the one making the promise and holding the money. Think of them as the bank for this specific agreement. Second, there's the policyholder. This is the person who owns the policy and is responsible for paying the premiums. Most of the time, this is you. Third, you have the insured. This is the person whose life is covered by the policy. If this person passes away, the company pays out. Again, this is almost always you. The policyholder and the insured are usually the same person, but not always. For example, a business might take out a policy on a key employee. And fourth, and most importantly, is the beneficiary. This is the person, the people, or even the entity like a trust that you designate to receive the money, the death benefit, when you're gone. This is your spouse, your children, your partner, your parents. This is who you are protecting. The money they receive, that death benefit, can be a lifeline. It can be used to pay for a funeral, which can easily cost over $10,000 in the US. It can completely pay off the mortgage on the family home, lifting the single biggest financial burden from their shoulders forever. It can replace your income for years, giving your family time to grieve and adjust without panicking about bills. It can pay off credit card debt, student loans, and car loans. It can ensure your kids still have money for college, or that your business partner has the funds to buy out your share of the company. That money buys something more valuable than anything else: time. It buys your family time to mourn, time to breathe, and time to figure out what their new future looks like, without the immediate crushing pressure of financial ruin. Now, once you understand that basic concept, you pay a little, they pay a lot. The next question everyone has is, okay, but what kind of life insurance do I get? This is where most people get tripped up because it seems like there are a million different options. But in reality, nearly every type of life insurance policy falls into one of two major categories. And the easiest way to understand them is by using an analogy we all know: renting versus buying a house. The first category is called term life insurance. Think of this as renting your insurance. When you rent an apartment, you sign a lease for a specific period of time, or a term, 1 year, 2 years, whatever it is. You pay your rent every month, and in return you get a place to live. If you stop paying rent, you get kicked out. When the lease is over, you can either renew it, probably at a higher price, or you can move out, and your right to live there is gone. Term life insurance works exactly the same way. You buy a policy for a specific term, typically 10, 20, or 30 years. You pay your monthly premium, and if you pass away at any point during that term, your beneficiaries get the full death benefit. Simple, it's straightforward, and because it's temporary, it is incredibly affordable. This is pure, no-frills protection designed to cover you when you need it most. When your kids are young, your mortgage is high, and your financial obligations are at their peak. Once the term is over, the policy simply expires. The coverage is gone. You got exactly what you paid for, protection for a set period. The second category is called permanent life insurance. The most common type of this is whole life insurance. Think of this as buying your insurance. When you buy a house, your monthly mortgage payment is significantly higher than a rent payment would be for a similar place. Why? Because you're not just paying for shelter, you're also building equity. A portion of every payment you make goes toward owning a valuable asset. You can borrow against that equity, and it grows over time. And as long as you keep making your mortgage payments, you own that house forever. Whole life insurance follows the same logic. The premiums are much, much higher than term life insurance. A big reason for that is because the policy doesn't expire. It's designed to last your entire life and guarantee a payout no matter when you pass away, whether it's at age 45 or 105. But just like a mortgage, a portion of your higher premium goes into a separate component called cash value. This cash value acts like a savings or investment account that grows over time with the guaranteed, albeit modest, interest rate. You can borrow money from this cash value or even surrender the policy later in life to take the cash out. It's a financial tool that combines a death benefit with the savings mechanism. So let's put it side by side. Term life is like renting. It's cheap, simple, and temporary. You get maximum protection for the lowest possible cost, but only for a specific time. There's no equity, no cash value. It's pure insurance. Whole life is like owning. It's expensive, complex, and permanent. It provides a lifelong death benefit and builds cash value you can use later. It's a blend of insurance and investment. For the vast majority of people in the United States, especially young families and middle-class households, term life insurance is going to be the most logical and cost-effective choice. It allows you to buy the large amount of coverage you actually need to protect your family during your working years without breaking the bank. But that begs the biggest question of all. How much coverage is enough? Is it 100,000? A million? 10 million? How do you even begin to calculate the right number for your family so you're not overpaying for coverage you don't need, or worse, leaving your family underprotected? Finding that sweet spot is the critical next step. And let's be honest, that process can feel overwhelming. It's like trying to guess the final score of a game that hasn't even started. Most people either pull a number out of thin air, or they just take the first number an insurance agent throws at them. Both are terrible strategies. One leaves your family vulnerable, the other drains your bank account for no reason. So let's demystify this. Let's turn this intimidating guess into a simple, logical calculation. Think of it not as buying a product, but as building a financial fortress for your family. The question is, how big does that fortress need to be? The quickest, dirtiest rule of thumb you'll hear everywhere is the 10 times your income rule. If you make $100,000 a year, you need $1 million policy. Simple, right? It's popular because it's easy to remember, and it sounds substantial. But this rule is like using a sledgehammer for a task that needs a scalpel. It completely ignores your unique life situation. Do you have a massive mortgage, or are you debt-free? Do you have one kid heading to an in-state school or 3 kids dreaming of Harvard? Are you 25 or 55? The 10x rule doesn't care. It's a one-size-fits-none solution that can be dangerously inaccurate. We need a smarter approach. A method that's tailored to your life, your debts, and your family's dreams. The most respected and straightforward way to do this is with a simple acronym: DME. That's DME. It stands for debt, income, mortgage, and education. By calculating these 4 things, you build a clear picture of the exact amount of money your family would need to maintain their standard of living if you were no longer there to provide for them. Let's break it down piece by piece. First, D is for debt. This is everything you owe except for your mortgage. We'll get to that separately. We're talking about credit card balances, car loans, student loans, personal loans, any debt that would get passed on or become a burden to your family. The goal here is total elimination. If you have $20,000 in student loans and a $15,000 car loan, you need to add $35,000 to your fortress fund right off the bat. Your family shouldn't have to worry about paying for your past while trying to build their future. Next, I is for income replacement. This is the biggest piece of the puzzle and the most important. The entire point of life insurance is to replace the paychecks you're no longer bringing home. The key question is, for how long? A common guideline is to provide income until your youngest child turns 18 and is no longer financially dependent on the household. So, if your youngest is 3 years old, you want to replace your income for the next 15 years. Let's do the math. Say you make $80,000 a year. You might think, okay, 80,000 times 15 years is $1.2 million. And that's a good start, but remember, your family won't have your expenses anymore. They won't be saving for your retirement or paying your life insurance premiums. So, a more conservative number is to replace about 75 to 80% of your income. So, 80,000 times, say 75% is $60,000 a year. Now, multiply that 60,000 by the 15 years your youngest child has until they're 18. That's $900,000. That's your income replacement number. That's the money that keeps the lights on, puts food on the table, and allows your family to live in the world you built for them without financial panic. Third, M is for mortgage. This is the single largest debt most American families have. Paying off the house is a monumental gift to your loved ones. It removes their biggest monthly expense and provides a profound sense of stability and security. No matter what happens in the world, they will have a roof over their heads, a place that is truly theirs, free and clear. This one's easy to calculate. You just look at your latest mortgage statement and write down the outstanding balance. If you owe $250,000 on your home, then you add $250,000 to your total. Finally, E is for education. For parents, this is a massive piece of the puzzle. We all dream of giving our kids the best possible start in life, and for many, that includes a college education. This number can vary wildly, but you need to be realistic. The cost of college is staggering and only going up. Are you planning for a state school or a private university? Do you have one child or four? A good starting point is to estimate at least $100,000 per child for a 4-year degree at a public university. If you have 2 kids, that's $200,000 you need to add to the calculation. This ensures that your dream for their education doesn't die with you. So let's put it all together using our dime formula. Let's imagine a family. The primary breadwinner makes $80,000 a year. They have debt, $35,000 in student loans and car payments. They need income replacement for 15 years, which we calculated as $900,000. Their mortgage balance is $250,000. And they want to fund the education for their 2 young children, so that's $200,000. You add it all up. $35,000 plus $900,000 plus $250,000 plus $200,000. The grand total is $1,385,000. That is the size of the financial fortress this family needs. Notice how different that is from the simple 10x income rule. That rule would have suggested an $800,000 policy, leaving this family over $500,000 short. That's the difference between peace of mind and potential disaster. The dime method gives you a number based on reality, not a random guess. But we're not quite done. There's one final critical step. After you've calculated your total need, your dime number, you get to subtract what you already have. This is the part that saves you money. Do you have existing savings or investments? Maybe you have a 401k with $100,000 in it. Maybe you already have a small life insurance policy through your job, say for $50,000. You subtract these existing assets from your total need. So for our example family that needs $1,385,000, if they have $150,000 in combined savings and work insurance, their actual life insurance need is $1,235,000. This is the precise, customized number they should be shopping for. Not a penny more, not a penny less. This process, calculating your dime and then subtracting your assets, is the single most powerful thing you can do to take control of your family's financial future. It replaces fear and uncertainty with clarity and confidence. You now have a real, tangible number. But this number leads to the next big question. $1 million policy sounds expensive, right? Well, it depends. It depends entirely on what kind of life insurance you buy. Because there are two fundamentally different types of life insurance out there, and they work in completely different ways with wildly different costs and benefits. One is simple, affordable, and acts like pure protection. The other is complex, expensive, and tries to double as an investment account. Choosing the right one is arguably just as important as choosing the right coverage amount. So, what are these two types and which one is the right choice for almost everyone? The first type is called term life insurance. Think of it like renting an apartment. It's simple, it's affordable, and it covers you for a specific period of time, the term. You need a place to live for the next 2 years while you're in a new city for a job. You don't buy a house. You rent. It's the most cost-effective solution for a temporary need. Term life insurance works the exact same way. You decide you need coverage for, say, 20 or 30 years, the period when your mortgage is the highest and your kids are still dependent on you. You pay a fixed monthly premium like rent. If you pass away at any point during that 20 or 30-year term, the insurance company pays your family the full death benefit, say $1 million tax-free. It's a clean, simple transaction. But what happens if the term ends and you're still alive? The policy simply expires. It's over. You stop paying the premiums and you no longer have the coverage. Just like when your 2-year lease is up, you move out of the apartment. You don't get your rent money back, but you got exactly what you paid for. A roof over your head for 2 years. With term life, you got exactly what you paid for. Peace of mind and a financial safety net for your family during their most vulnerable years. Now you might be thinking, wait a minute, if I outlive it, I get nothing back? Did I just waste all that money? And that is the single biggest misunderstanding about term life insurance. Let me ask you this. If you pay for car insurance for 20 years and never get into a single accident, did you waste your money? Or if you pay for homeowner's insurance and your house never burns down, was that a waste? Of course not. You were paying for protection against a catastrophic financial loss. You were paying for security. Outliving your term life policy isn't a loss. It's the ultimate win. It means you're still here. It means your kids grew up, the mortgage got paid down, and you successfully navigated the most financially fragile chapter of your life. You paid a small, affordable price to guarantee your family would be okay no matter what. That's not a waste. That's brilliant planning. And the reason term insurance is so incredibly affordable is based on a simple statistical fact. Most people outlive their policies. Insurance companies are experts at math. They know the precise probability of a healthy 35-year-old passing away before they turn 65. Because the risk is relatively low, the price is also low. You're not paying for anything extra. No bells, no whistles. Just pure, unadulterated protection. It's the right tool for the job. The other type of life insurance is called permanent life insurance. And if term life is like renting an apartment, permanent life is like buying a house with a very complicated mortgage from a very pushy salesman. It's designed to last your entire life. It never expires as long as you keep paying. And just like buying a house, the monthly payment is dramatically higher. We're not talking a little more. We're talking 5, 10, even 15 times more expensive than a term policy for the same amount of coverage. So why on earth would anyone pay so much more? Because permanent life insurance tries to be two things at once. It's a death benefit, and it's a savings or investment account, all bundled together. This investment component is called the cash value. Here's how it works. When you pay your massive monthly premium, only a portion of it goes to cover the actual cost of the insurance, the part that's like your term policy. The rest of your money, after some very hefty fees and commissions are skimmed off the top, gets put into this cash value account. This account then grows over time, tax deferred. The sales pitch is incredibly alluring. The agent will say, "Why would you just rent your life insurance and throw your money away? With our policy, you can own it. You build equity, cash value, that you can borrow against or even use for your retirement. It's a forced savings plan." It sounds amazing, right? A life insurance policy that makes you money. But this is where we have to pull back the curtain and look at what's really going on. There are a few main flavors of permanent insurance, and they just get more and more complex. The oldest is whole life. It has fixed premiums and a guaranteed, but very slow cash value growth. Think of it like a savings account with an interest rate that barely keeps up with inflation, but with enormous fees attached. Then there's universal life, which is more flexible. You can adjust your payments, but the cash value growth is tied to fluctuating interest rates, which introduces risk. If you don't pay enough into it, or if interest rates tank, your policy could actually implode and you could lose everything. And then you have variable universal life, where your cash value is actually invested in sub-accounts that look like mutual funds. This offers the potential for higher returns, but also the very real risk of significant losses. You are taking on all the market risk, but with the added layers of insurance costs and administrative fees that will absolutely decimate your returns compared to just investing directly in the market yourself. Here is the fundamental problem. The reason why permanent life insurance is the wrong choice for over 95% of Americans. First, the cost. It is astronomically expensive. That high price prevents most people from buying the amount of coverage they actually need. They end up with a $100,000 policy that builds cash value, when what their family really needed was a $1 million term policy to actually replace their income. Second, the returns on that cash value are, frankly, terrible, especially in the first 10 to 15 years. Why? Because a huge chunk of your premium is going straight into the pockets of the insurance company and the agent who sold it to you. The commissions on these policies are massive. Your investment starts deep in the red. This leads to the most important concept you need to understand. Buy term and invest the difference. Let's use a real-world example. A healthy 30-year-old man might be able to get a $1 million 30-year term policy for about $60 a month. A whole life policy with the same $1 million death benefit might cost him $800 a month. That's a difference of $740 every single month. The insurance agent wants you to give him that $800. He'll put a tiny bit toward your insurance and invest the rest for you in his high-fee, low-return cash value account. But what if you were smarter? What if you bought the $60 term policy, getting the exact same $1 million of protection for your family, and then you took the $740 you saved and invested it yourself every month in a simple low-cost S&P 500 index fund? After 30 years, the cash value in that whole life policy might have grown to a couple $100,000 if you're lucky. But that $740 you invested yourself, assuming a conservative average market return, you'd be looking at a nest egg of well over $1.5 million. It's not even a close comparison. You get the same protection, but you end up with 5 or 6 times more money in your own pocket, in an account that you control with full transparency and minimal fees. Permanent life insurance is sold as a solution for 2 separate financial problems: the risk of dying too soon and the need to save for the future. But by bundling them together, it creates a product that does a poor job at both. It provides inadequate, expensive death protection, and it's a horrible, fee-ridden investment vehicle. The only person it truly benefits is the one who sells it to you. So the choice becomes crystal clear. For the vast majority of us, the goal is simple. We need to protect our income and our families for a specific period of time. The most efficient, affordable, and honest way to do that is with term life insurance. It does one job, and it does it perfectly. You get the maximum amount of protection for the lowest possible cost, freeing up your most powerful wealth-building tool, your income, to actually build wealth for your future. Now that we've established that term is the way to go, the next critical question is a big one. How much do you actually need? Is it 10 times your salary? 20 times? Is there a magic number? Getting this wrong can be just as devastating as having no insurance at all. And the way to figure it out is more straightforward than you think. Let's start with the biggest myth out there: the 10 times your salary rule. You've probably heard it. It's simple, it's catchy, and it's dangerously wrong for most people. Using a generic rule of thumb for life insurance is like a doctor prescribing the same medicine to every patient, regardless of their illness. For a young family with a huge mortgage and 2 toddlers, 10 times their salary might be tragically insufficient. For an empty nester with a paid-off house and a fat retirement account, it could be way too much. Your life isn't a rule of thumb. Your family's future isn't a ballpark estimate. It's a custom-built reality that requires a custom-built plan. So let's throw that rule out the window and build your number from the ground up, using a simple, powerful framework. Think of it like building a financial fortress for your family. We need to calculate exactly what it would take to keep them safe and secure if you were no longer there to provide for them. The easiest way to remember this is with the acronym DIME. That's DIME. It stands for debt, income, mortgage, and education. Let's break down each letter. First up is D for debt. This is the first, most immediate storm your family would face. We're talking about every single non-mortgage debt you have. Pull out a piece of paper or open a spreadsheet. List your car loans, student loans, credit card balances, personal loans, any money you owe that isn't your home loan. The goal here is to completely wipe that slate clean. Imagine the relief your spouse or partner would feel, knowing that in the midst of their grief, they don't have to worry about a car payment or a looming credit card bill. This isn't about luxury. It's about removing immediate, crushing stress. So add it all up. Let's say you have a $15,000 car loan and $25,000 in student loans. Your number for D is $40,000. Simple. Next, the biggest piece of the puzzle, I for income replacement. This is the core of life insurance. It's about replacing your paycheck so your family can maintain their standard of living. The key question is, for how long? This is where it gets personal. A common approach is to have enough to last until your youngest child turns 18 and is out on their own. If you have a 2-year-old, you'll need to replace your income for at least 16 years. If your kids are already in high school, maybe you only need 5 or 6 years. Think about your specific situation. Does your spouse work? Do they have a career they could ramp up? Or are they a stay-at-home parent who would need significant time and resources to re-enter the workforce? You have to be brutally honest here. Let's say you earn $75,000 a year, and you have a 4-year-old and a 6-year-old. You decide you want your income replaced for 14 years, until your youngest is 18. The math is straightforward. $75,000 times 14 years equals $1,050,000. That's your I. Yes, it's a big number. Supposed to be. It reflects the immense value you provide over many years. It's the financial engine of your family. Now for M, the mortgage. Why is this separate from other debts? Because for most American families, it's the single largest liability they have. More than that, a house isn't just a debt. It's a home. It's stability. It's the school district your kids love, the neighbors they play with, the backyard where they feel safe. The last thing you want is for your family to be forced to sell their home during the most difficult time of their lives because they can no longer afford the payments. The goal of the M and dime is to pay off the house. Period. This gives your family the ultimate security. A roof over their heads that is 100% theirs forever. This calculation is the easiest of all. Just look at your latest mortgage statement and find the remaining principal balance. Let's say you owe $300,000 on your home. That's your M, done. Finally, we have E for education. This is about looking to the future. This is about ensuring your kids have the same opportunities you always dreamed of giving them, even if you're not there to see it. For most, this means college. And as we all know, college is incredibly expensive. You're not just funding a dream. You're funding a very specific, very large future expense. So how much do you need? You can look up the current average cost of a 4-year degree at a public or private university in your state. A safe, conservative estimate might be to set aside $100,000 per child for a public university and maybe $200,000 or more for a private one. You decide what kind of legacy you want to leave. If you have 2 children and you want to ensure they can get a solid 4-year degree without going into massive debt, you might budget $125,000 for each. Your E would then be $250,000. This part of the calculation is about preserving future choices for your children. Okay, let's put it all together using our example. D for debts was $40,000. I for income was $1,050,000. M for mortgage was $300,000. And E for education was $250,000. Add them all up. $40,000 plus $1,050,000 plus $300,000 plus $250,000 gives us a total of $1,640,000. Right now, you might be thinking, $1.5 million? That's an insane amount of money. I could never afford that. And this is the point where most people get scared and give up. But we're not done. This is the most important part of the equation, the step that brings that intimidating number back down to earth. You see, the number we just calculated is your family's total need. But that's not necessarily how much life insurance you have to buy. The final step is to subtract the assets you already have. You don't need to buy insurance to cover things you've already saved for. So let's make a second list. What financial resources would your family have access to? First, liquid savings. How much do you have in checking, savings, or money market accounts? Let's say it's $20,000. Second, long-term investments. This includes brokerage accounts, your 401k, an IRA, or any other retirement funds. Be realistic. You don't want your spouse to have to drain their own retirement account to survive, but these funds are part of the safety net. Let's say you have $150,000 in your 401k. Third, do you already have any life insurance? Many people have a small policy through their job, often equal to 1 or 2 times their salary. Let's say your work provides a free policy worth $75,000. Finally, are there college savings accounts like a 529 plan that you've already started for the kids? Let's imagine you have $15,000 saved up for each of your 2 kids, so that's $30,000 total. Now let's add up your assets. $20,000 in savings, $150,000 in your 401k, $75,000 from your work policy, $30,000 in college funds. That's a total of $275,000 in existing assets. Now for the final critical calculation. You take your family's total need, that big $1,640,000 number, and you subtract your existing assets of $275,000. The result is $1,365,000. That is your number. That is your life insurance coverage goal. It's not a generic rule of thumb. It's a number built specifically for you, your life, your debts, your family, and your dreams for them. It's not just a number. It's a plan. It's the blueprint for that financial fortress. It's the exact amount of capital required to see your family through the worst-case scenario. It might still seem like a big number. Maybe you round it up to a clean $1.5 million. But it's a real tangible number you can now take action on. So now you have your number. A big, important number. But what does a policy for over $1 million actually cost? Is it a fortune? Hundreds of dollars a month? The answer is going to shock you. We're about to break down the real-world costs and reveal the single biggest factor that determines your price tag. And it's something you have more control over than you think. So what's the price of peace of mind? If you ask most people on the street, they'll guess it costs a fortune. They picture a bill the size of a car payment. But for a healthy 30-something, a $500,000 policy can cost less than their Netflix and Spotify subscriptions combined. Sometimes as little as $30 a month. Yes, you heard that right. $30. For others, that same $500,000 policy could cost $200 a month. So what gives? Why the massive difference? It all comes down to one word: risk. When you apply for life insurance, the company is making a bet. A very calculated statistical bet on how long you're going to live. The lower they think the risk is that you'll pass away during your policy term, the less they charge you. The higher the risk, the more they charge. It's that simple. They aren't just pulling numbers out of a hat. They are professional risk assessors, and they've built a powerful system to create what's called your risk profile. And the single biggest factor in that profile, the one that can swing your price by hundreds of dollars, is your health. And this is the part you have incredible control over. To see how this plays out in the real world, let's imagine two people. We'll call them Alex and Ben. Alex and Ben are identical on paper in many ways. They're both 35 years old. They both work desk jobs in marketing. They both want to buy a $500,000, 20-year term life insurance policy to protect their families. But that's where the similarities end. Alex is a non-smoker. He goes to the gym a few times a week, maintains a healthy weight, and his blood pressure and cholesterol are in the ideal range. His parents are both alive and well in their 60s. When Alex applies for life insurance, the company sees him as a fantastic bet. He is the definition of low risk. His quote comes back at around $35 per month for $500,000 of coverage. Now let's look at Ben. Ben is also 35, but Ben smokes a few cigarettes a day. He's about 30 pounds overweight, and his job is completely sedentary. His diet isn't great, and his blood pressure is a little on the high side. To top it off, his father had a heart attack at age 55. When the insurance company looks at Ben's application, they see a completely different picture. They see multiple red flags. Smoking alone is one of the most significant risk factors. Combined with the weight, the blood pressure, and the family history, Ben is considered a much higher risk. He is a less certain bet. His quote for the exact same $500,000, 20-year term policy comes back at $160 per month. That's not a typo. Alex pays $35. Ben pays $160. Over the 20-year term of the policy, Alex will pay a total of $8,400. Ben will pay $38,400. That's a $30,000 difference, all for the exact same amount of protection. This is the power of your health and lifestyle in the world of life insurance. So let's break down exactly what the insurance company is looking at when they build your profile. Think of it like a checklist. First and most obviously is your age. This is the one factor you can't control, but you can control when you act on it. The younger you are when you buy a policy, the cheaper it will be, period. A 30-year-old will always pay less than a 40-year-old for the same coverage because statistically, the 30-year-old has more healthy years ahead of them. The cost of waiting just 1 year can be significant, but the cost of waiting a decade can be astronomical. It's the ultimate early bird discount. Second, the big one we just saw with Alex and Ben, your health and lifestyle. This is where the insurance company does its deep dive. For most policies, this involves a simple medical exam. Don't let this scare you. It's not an interrogation. A nurse typically comes to your home or office, and it takes about 20 minutes. They'll take your height and weight, check your blood pressure, and take a small blood and urine sample. These samples are then tested for a whole range of things. They're checking your cholesterol levels, your liver and kidney function, signs of diabetes, and crucially for nicotine and other drug use. Lying about smoking is one of the worst mistakes you can make. If you say you're a non-smoker and the test shows nicotine, your application will be denied, and it gets flagged in an industry database, making it harder to get insurance elsewhere. Always be honest. Your overall health history is also huge. They'll look at your medical records for any pre-existing conditions like heart disease, diabetes, or cancer. But having a condition doesn't automatically mean you can't get coverage. What they want to see is that you are managing it responsibly. A well-controlled diabetic who follows their doctor's orders is a much better risk than someone who ignores their health. Then there's your family history. They are primarily concerned with your immediate biological family, your parents and siblings. They're looking for a history of hereditary diseases, especially ones that occurred at an early age like cancer or heart disease before the age of 60. This is what hurt Ben in our example. Third on the checklist is your gender. This might seem outdated, but it's pure statistics. On average, women in the US live about 5 years longer than men. Because of this longer life expectancy, women often pay slightly less for life insurance than men of the same age and health profile. Fourth is your occupation. An accountant who works in a quiet office is a lower risk than a deep-sea fisherman or a commercial pilot. If your job involves significant physical danger, your premium will reflect that. Most jobs, however, fall into the standard risk category and won't affect your rates at all. And finally, your hobbies and habits. Do you have a passion for skydiving, rock climbing, or racing cars? These activities, while thrilling, carry a higher risk of accidental death, and the insurance company will factor that in. Sometimes they'll charge a higher premium, and sometimes they may add an exclusion to the policy for that specific activity. Again, honesty is crucial. Now, looking at that list can feel intimidating. You might be thinking, well, I'm not a perfect specimen of health. My dad had high blood pressure. I could stand to lose 10 pounds. And that's okay. This is the most important myth to bust. You do not need to be a super athlete to get affordable life insurance. Insurance companies have different health classifications. Think of them like grades. The top tier is usually called Preferred Plus or Super Preferred. This is for the Alexes of the world, people in excellent health with a clean family history. They get the absolute best rates. Below that, you have Preferred, for people in great health who might have a minor issue like slightly elevated cholesterol. Then you have Standard Plus and Standard, which is where most people land. These are for generally healthy individuals who might be a bit overweight or have well-controlled health conditions. And even below that, there are Substandard, or table-rated classes for individuals with more significant health concerns. The goal isn't to be perfect. The goal is to get into the best health class you can. And this is where your control comes in. You can't change your age or your family history, but you can take steps to improve your health before you apply. If you're a smoker, quitting is the single most impactful thing you can do to lower your life insurance costs. Most companies will offer you non-smoker rates after you've been nicotine-free for just 12 months. Losing weight, getting your blood pressure under control, improving your diet, these actions don't just add years to your life, they can save you tens of thousands of dollars on your life insurance. It's a direct financial reward for taking care of yourself. So we've pulled back the curtain on the price tag. You now understand that the cost isn't some random scary number. It's a predictable price based on a personal risk profile that you have a surprising amount of influence over. We've cracked the code on how much you'll pay. But now comes the million-dollar question. What kind of policy should you actually buy? You're about to enter the biggest battle in the life insurance world. Term versus whole life. One is like renting a home, the other is like buying it. Choosing the wrong one can cost you a fortune and leave your family with a useless financial product. In the next part, we'll give you the simple framework to make the right choice once and for all. So, you have two doors in front of you. Behind door number 1 is term life insurance. Behind door number 2 is permanent life insurance. This is the single biggest decision you will make, the fork in the road that determines whether you get a simple, affordable safety net or a complex, expensive financial product. Let's break it down using the analogy we just mentioned. Renting versus buying a home. Think of term life insurance as renting an apartment. You need a place to live for a specific period of time. Maybe you're in a city for a 5-year job assignment. You pay your monthly rent and in return you get a roof over your head. It's straightforward. It's affordable. It perfectly serves your temporary need. When the lease is up, you move out. You don't get your rent money back, but that's not the point. The point was the protection and security you had while you were living there. Term life insurance works exactly the same way. You buy it for a specific term, typically 10, 20, or 30 years. You pay a fixed monthly premium, which is usually very low when you're young and healthy. If you pass away during that term, your family gets the full tax-free death benefit. $1 million policy pays out $1 million. Simple. But if the term ends and you're still alive, which is great news, the policy simply expires. It's gone. You don't get your premiums back. Just like with rent, you were paying for the what if. You were paying for the peace of mind, for the guarantee that if the worst happened, your family would be protected. This is the perfect solution for most people's biggest financial worries, because most of our biggest financial responsibilities are temporary. You have a 30-year mortgage? A 30-year term policy covers it. You have young children and want to make sure their college is paid for, and they're supported until they're adults? A 20-year term policy will get you there. You've just started a business and have a 10-year small business loan? A 10-year term policy ensures your partner isn't left with the debt. The need is temporary, so the solution should be, too. It's clean, it's cheap, and it's incredibly effective. Now let's look behind door number 2. Permanent life insurance. This isn't renting, this is buying the house. When you buy a house, your monthly mortgage payment is much higher than a renter's payment for a similar property. Why? Because you're not just paying for the roof over your head. A portion of your payment is going towards interest and taxes, sure, but a significant chunk is going towards building equity. You are slowly but surely building an asset, a valuable piece of property that you own. Permanent life insurance works in a similar way. The premiums are dramatically higher than term insurance, often 5 to 15 times more expensive for the same death benefit. A fraction of that high premium pays for the actual cost of the insurance, but the rest goes into a savings or investment component inside the policy, called the cash value. This cash value is your equity. It grows over time, typically on a tax-deferred basis. You can borrow money against this cash value, or if you decide you don't need the policy anymore, you can cancel it and walk away with the accumulated cash. And because it's permanent, the policy is designed to last your entire life. As long as you keep paying that high mortgage payment, the policy will be there, guaranteed to pay out when you eventually pass away. Now this sounds pretty good, right? A death benefit and a savings account all in one. This is the sales pitch. But here's the critical part they don't always tell you. It's an extremely expensive way to save money. The fees are high, the growth is often slow compared to traditional investments, and the rules are complex. There are different kinds of permanent insurance like whole life, which is like a predictable fixed-rate mortgage, and universal life, which is more like a flexible and sometimes risky adjustable-rate mortgage. They all package insurance and investing together. So who is this for? It's not for the family that just needs to cover the mortgage. It's a specialized tool for the very wealthy. Think of someone who has an estate so large it will be subject to massive estate taxes. They can use a permanent life insurance policy to provide immediate, tax-free cash for their heirs to pay that tax bill without having to sell off family assets. Or it's for someone who has already maxed out every other possible retirement and investment account, their 401k, their Roth IRA, and is looking for another tax-advantaged place to put their money. For about 95% of the American population, this is simply not their situation. This brings us to the great debate in personal finance, the simple concept that cuts through all the noise. Buy term and invest the difference. The logic is undeniable. Let's take a healthy 35-year-old man. He wants a $1 million death benefit to protect his family. He gets 2 quotes. The first is for a 30-year term policy. The premium is about $70 per month. The second is for a permanent whole life policy with the same $1 million death benefit. The premium is a staggering $950 per month. The buy term and invest the difference strategy says, take the simple, cheap option, the $70 a month term policy. Then take the money you save, the difference between the 2 premiums, which is $880 a month, and invest it yourself. If you invest that $880 every single month for 30 years in a simple, low-cost S&P 500 index fund, and you get a historically average return of, say, 9%, how much money do you think you'd have at the end of 30 years? The answer is over $1.7 million. Let's be clear. At the end of 30 years, your term policy expires. You have no more life insurance from that policy, but you don't need it anymore. Your mortgage is paid off, your kids are grown, and you have a $1.7 million nest egg that you control completely. You have become self-insured. Compare that to the whole life policy. After 30 years, you'd still have the death benefit, yes, but the cash value, your equity, would likely be less than half of what you could have accumulated by investing on your own. You paid a huge price for someone else to manage your money poorly. Now, the defenders of permanent life insurance will make one valid point: human behavior. They'll say that people say they'll invest the difference, but they won't. They'll see that extra $880 in their bank account and spend it on vacations, cars, and dinners out. The permanent policy, they argue, acts as a forced savings plan. Forces discipline. And while that's true for some, it's an incredibly inefficient and expensive way to build discipline. It's like paying a personal trainer $1,000 an hour to just yell at you to get off the couch. You're better off learning the discipline yourself by setting up automatic transfers to your investment account and keeping the massive gains for your own family. So, here is the simple framework we promised. The 2 questions that will give you the right answer once and for all. First, ask yourself, is the financial need I'm trying to protect temporary or permanent? If you're protecting a mortgage, your kid's childhood, or a period of debt, the need is temporary. The answer is term life. If you have a lifelong dependent with special needs or you're trying to manage a massive estate tax bill, the need might be permanent. Only then should you even begin to consider permanent life. Second, if you're even thinking about permanent life as an investment, ask yourself this: have I already contributed the absolute maximum amount allowed by law to all of my other tax-advantaged retirement accounts? Have you maxed out your 401k? Have you maxed out your Roth IRA? If the answer is no, you have absolutely no business using a high-cost life insurance policy as an investment vehicle. Focus on the proven low-cost wealth-building tools first. For the vast majority of people watching this, the answer will be crystal clear. You need term life insurance. It's not a sexy product. It's not a clever investment. It is a simple, powerful, and affordable tool that does one job perfectly. It protects your family when they need it most. It is the right choice. But choosing the right type of insurance is only half the battle. Getting the amount of coverage wrong is just as dangerous as picking the wrong policy. Too little, and you leave your family vulnerable. Too much, and you're wasting money every single month that could be going towards building your own wealth. In the next part, we'll reveal the simple back-of-the-napkin formula to calculate exactly how much life insurance you actually need, down to the dollar. So, how do you figure out that magic number? How much coverage is enough and how much is just overkill? Forget the complicated financial models and the confusing jargon from insurance agents. The best method is one you can literally do on the back of a napkin. It's a simple acronym: DIME. Debt, income, mortgage, and education. Let's break it down step by step and build a real-world example as we go. First up is D for debt. This is the starting point. You need to gather up every single non-mortgage debt you have. We're talking about car loans, student loans, credit card balances, personal loans, anything that would get left behind for your family to deal with. The goal here is to wipe the slate clean for them. Imagine the relief your loved ones would feel if, in the midst of their grief, they learned that every single one of those monthly payments just vanished. For our example, let's say you have a $15,000 car loan, $25,000 in student loans, and about $5,000 in credit card debt. Add it all up. That's a total of $45,000 for the D in DIME. Next, we have I for income. This is usually the biggest piece of the puzzle. The whole point of life insurance is to replace the income you would have earned to provide for your family. The most common rule of thumb you'll hear is to have 10 times your annual income in coverage. So if you make $70,000 a year, that's $700,000. Now, why 10 years? It's a solid benchmark that gives your family a significant runway. It gives them time to grieve without panicking about bills. It allows your spouse to potentially stay home with the kids for a few years, or to retrain for a new career, without the immediate pressure of replacing your entire salary. It's a decade of stability. Now, is 10 years a perfect number for everyone? No. If your kids are very young, say toddlers, you might want to consider 15 or even 20 years of income replacement. You have a longer road ahead to get them to adulthood. If your kids are already in high school and your spouse has a great stable career of their own, maybe you only need 7 or 8 years. But for most people, 10 is a fantastic safe starting point. So, for our running example, let's stick with that. Our person makes $70,000 a year, so we'll add $700,000 to our total for I. The third letter is M for mortgage. This one is simple. What is the outstanding balance on your home loan? The single greatest gift you can leave your family is a paid-off house. It removes their single largest monthly expense forever. It provides a level of security and stability that is almost impossible to overstate. They will always have a roof over their heads, a place filled with memories that is truly theirs. So go to your latest mortgage statement and find that payoff amount. Let's say for our example you have $250,000 left on your mortgage. That's our number for M. And finally, E for education. This is primarily for those with children who plan to help them with college expenses. This number can feel a bit like guesswork, but we can make an educated estimate. The cost of college is staggering and it's only going up. A good strategy is to look at the current average cost of a 4-year degree at a public, in-state university. Right now, that's hovering around $25,000 to $30,000 a year all in. So for a 4-year degree, you're looking at $100,000 to $120,000 per child. If you have 2 kids, you'd want to budget around $200,000 to $240,000 for their education. This ensures they can pursue their dreams without being saddled with crippling student loan debt, a gift that will change the entire trajectory of their financial lives. For our example, let's say we have 2 kids and we want to be safe, so we'll budget $125,000 for each. That's another $250,000 for each. Okay, let's add it all up. We have D for debt at $45,000, I for income at $700,000, M for mortgage at $250,000, and E for education also at $250,000. When you add all of that together, you get $1,245,000. Now, you might be looking at that number and thinking, $1 million policy? That sounds insane. The premiums must be astronomical. And this is the point where most people get scared off. But hold on, because we're not done. There's one more crucial step. After you add everything up, you need to subtract what you already have. This is the part of the equation that brings it all back down to earth. You need to take a look at your existing assets. Do you have a savings account? A 401k or an IRA? Other investments in a brokerage account? Any existing life insurance coverage like a small policy you might have through your job? All of these things are part of your financial safety net. Let's say our example person has $50,000 in their 401k, another $25,000 in savings and investments, and a $50,000 policy through work. That's a total of $125,000 in existing assets. So you take your big total, $1,245,000, and you subtract your assets of $125,000. The final number, the actual amount of life insurance you need to go out and buy, is $1,120,000. And suddenly, that feels a lot more specific and a lot less like a random scary number. You can even round it up to 1.2 million or down to 1.1 million for simplicity. This is your number. This is the amount that wipes out all your debts, pays off the house, secures your kids' education, and replaces your income for a decade, all while accounting for the savings you've already built. That is a plan. That is peace of mind. Now, the DIME method is a fantastic framework for most people, but what if your situation is a little different? What about stay-at-home parents? They don't have a traditional income to replace, so does that mean they don't need life insurance? Absolutely not. In fact, a stay-at-home parent provides enormous economic value that would be incredibly expensive to replace. Think about it. Childcare, cooking, cleaning, managing the household, transportation, tutoring. If you had to hire people to do all of those jobs, what would it cost? The national average cost for full-time childcare alone can be $10,000 to $20,000 per year, per child. When you add up all the other services, some estimates put the economic value of a stay-at-home parent at over $150,000 a year. So when calculating their life insurance needs, you should use that replacement cost as their income in the DIME formula. Their passing would create a massive financial hole, and the insurance is there to fill it. One other small but important category to consider is final expenses. This includes costs for a funeral, burial, or cremation, and any final medical bills. These expenses can easily run from $10,000 to $15,000, and they often need to be paid immediately. You don't want your family scrambling to find that cash during the worst week of their lives. So it's a good idea to add about $15,000 on top of your DIME total, just to ensure those immediate needs are covered without any stress. Calculating this number isn't just a morbid math exercise. It's an act of profound love and responsibility. It's looking at your family and saying, if the worst happens to me, I have built a financial fortress around you. You will get to stay in our home. The kids will get to go to college. You will have time and space to grieve without the crushing weight of financial panic. It transforms life insurance from a vague, unpleasant thought into a concrete tool for protecting the people you care about most. It's the ultimate I love you, written into a financial contract. Now that you have your number, the exact amount of coverage you need to protect your family, the next question is the most important one of all. What kind of life insurance do you buy? You walk into the marketplace and you're hit with a dozen different options, but it really all boils down to a massive battle between two heavyweights: term life and whole life. Choosing the wrong one isn't just a small mistake. It's a decision that could cost you hundreds of thousands of dollars and leave you with a policy that fails you when you need it most. So let's step into the ring. In one corner you have the lean, efficient, undisputed champion of value: term life insurance. Think of term life as renting an apartment. You need a place to live for a specific period, say the 30 years you're raising kids and paying off a mortgage. You find a great apartment, sign a lease, and pay your monthly rent. For those 30 years you are fully protected. You have a roof over your head. If something happens to the building, the landlord is responsible. Simple, predictable, and by far the most cost-effective way to get that protection. At the end of the 30-year lease, you move out. You don't own the apartment, you didn't build any equity in it, but that was never the point. The point was affordable, straightforward protection for the exact period you needed it. That's term life insurance. You choose a term, typically 10, 20, or 30 years, and a death benefit amount, say $1 million. You pay a fixed monthly premium for that entire term. If you pass away at any point during those 30 years, your family gets the full $1 million tax-free. If you're still alive at the end of the 30 years, the policy expires. You got exactly what you paid for. Peace of mind and financial protection during your most vulnerable years. And the cost for this? It is shockingly low. A healthy 30-year-old can often get $1 million, 30-year term policy for around $50 to $70 a month. That's it. For the price of a few fancy coffees, you can ensure your family is a millionaire if the worst happens. It's pure, unadulterated insurance. It does one job, and it does it exceptionally well. Now, in the other corner, weighing in at a much heavier price point, is the complex challenger, whole life insurance. If term life is like renting an apartment, whole life is pitched as buying a house. It sounds better, right? Ownership, permanence, building equity. The sales pitch is seductive. Why just rent your insurance when you can own it? This policy lasts your whole life, and part of your payment builds up a cash value you can borrow against later on. It's an asset. And this is where the dream starts to unravel. Yes, a whole life policy is permanent. It will pay out whether you die at 35 or 105, as long as you keep paying the premiums. And yes, it has a savings component called cash value. A portion of your premium goes to the cost of the insurance, and another portion goes into this cash value account, which grows at a slow, fixed-rate, tax-deferred. Sounds okay, right? But let's look closer at this house you're buying. The mortgage on it is terrible. The interest rate is abysmal. And it's loaded with hidden fees and commissions that eat away at your returns. That $50 a month term policy we just talked about? A whole life policy with the same $1 million death benefit for that same 30-year-old could cost anywhere from $500 to $800 a month, or even more. Let that sink in. 10 to 15 times the cost for the same death benefit. Why? Because you're not just buying insurance anymore. You're being forced to bundle it with a low-performing, high-fee investment product. The cash value that agents rave about grows at an incredibly slow pace, especially in the early years, because a huge chunk of your premium is going straight into the insurance company's pocket and the agent's commission. And here's the knockout punch. This is the single most important concept in personal finance that could save you hundreds of thousands of dollars. It's called buy term and invest the difference. Let's do the math. Our 30-year-old can get $1 million term policy for, let's be generous, $60 a month. The agent for whole life quotes them $600 a month for the same coverage. That's a difference of $540 every single month. The agent will say, but with whole life, you're building cash value. Okay, let's see what happens if we take matters into our own hands. We buy the $60 term policy. We are now fully insured. Then we take that $540 we saved and invested ourselves every month into a simple, low-cost S&P 500 index fund. For 30 years, assuming a conservative average annual return of 8%, well below the historical market average, What do you think you'd have at the end of those 30 years? The cash value in your whole life policy might have grown to maybe $250,000 or $300,000. It's something, but it's not life-changing. But your personal investment account? By buying term and investing the difference yourself? After 30 years, you would have over $735,000. At a 10% average return, which is closer to the historical average, you'd have over $1.2 million. $1 million in your own account that you control completely, all while having the exact same $1 million life insurance protection for your family along the way. You have become self-insured. You no longer need the life insurance because you have a massive nest egg that can provide for your family. You beat the system. This isn't a trick. It's just math. Whole life insurance combines two things, insurance and investing, and does both of them poorly. It gives you overpriced insurance and a terrible investment vehicle, all wrapped up in a complicated package designed to confuse you. So why on earth does it even exist? Why do agents push it so hard? The answer is ugly, and it's one of the dirtiest secrets of the financial industry. Commissions. The commission an agent makes on a term life policy is small. For that $60 a month policy, they might make a few $100s. It's not much, but the commission on a whole life policy, it's a monster. Often, the agent receives 50 to 100%, or even more of your entire first year's premium. On that $600 a month policy, the agent could be walking away with a check for $5,000, $6,000, even $7,000. From one sale to you. They are not selling you what's best for you. They are selling you what's best for them. They are incentivized to sell you the most expensive, most profitable product, not the most effective one. They'll use emotional language, talk about permanence and leaving a legacy, and show you confusing charts where the cash value eventually looks appealing, but they will almost never show you the simple, devastating math of buy term and invest the difference. For over 95% of the American population, the debate is over. Term life is the clear, undisputed winner. It provides the maximum protection for the lowest possible cost, freeing up your most powerful wealth-building tool, your income. It allows you to take control of your own financial future, instead of handing it over to an insurance company in exchange for mediocre returns and staggering fees. But what about that other 5%? Is there ever a time, a specific situation, where the permanence and tax advantages of whole life or its complex cousins, like universal life and variable life, actually make sense? The truth is yes. But these situations are rare, and they typically apply to the ultra-wealthy with very specific estate planning problems. For them, it can be a strategic tool. For everyone else, it's often a trap, a financial dead end dressed up as a sophisticated solution. So how can you know for sure which camp you fall into? And what are these other exotic types of policies that agents might try to sell you next? Let's start by answering that critical question. Who is permanent life insurance actually for? If it's a bad deal for most people, who are the exceptions? There are really only two groups who should seriously consider it. The first group is the ultra-wealthy. We're talking about people with estates so large they'll be subject to the federal estate tax. As of right now, that tax kicks in for estates worth over about $13 million for an individual, or $26 million for a married couple. When someone in this wealth bracket passes away, their heirs could face a massive tax bill, often up to 40% of the value above that exemption. Now imagine their wealth isn't in cash. It's tied up in a family business, a large farm, or a significant real estate portfolio. The heirs might be forced to sell off these legacy assets, maybe even break up the family business, just to pay the IRS. This is where a massive whole life or universal life policy becomes a strategic tool. The death benefit, which is paid out income tax-free, provides a huge, immediate infusion of cash. It's like a pre-funded, tax-free vault that unlocks at death, giving the heirs the exact liquidity they need to pay the estate taxes and keep the family's assets intact. For them, the high premiums aren't a burden. They're a calculated cost to preserve generational wealth. The second group is far more common, and it's a situation that requires incredible foresight and love. This group consists of parents or guardians of a child with a permanent disability who will require lifelong care. Their greatest fear is, what happens to my child when I'm gone? Government benefits like Medicaid and supplemental security income are a lifeline, but they have strict income and asset limits. If these parents were to leave a large inheritance directly to their child, it could instantly disqualify them from receiving the very benefits they depend on for medical care and housing. The solution is a legal structure called a special needs trust. This trust can hold assets for the benefit of the disabled individual without that money counting as their own. And how do you fund that trust to ensure it has enough money to last for decades after you're gone? You use a permanent life insurance policy. The parents pay the premiums throughout their lives, and upon their death, the policy's death benefit flows directly into the trust, creating a fund to pay for all the things government benefits don't cover: special equipment, travel, companionship, a better quality of life, all without jeopardizing their essential public assistance. In this case, the permanent policy isn't an investment. It's the ultimate safety net, a guarantee of care that extends beyond the grave. If you don't fall into one of those two very specific categories, either needing to pay estate taxes or fund a special needs trust, the odds are astronomically high that permanent life insurance is not the right tool for you. So with that understood, let's pull back the curtain on those other exotic policies. Because once an agent realizes you might be skeptical of whole life, they'll often pivot to its supposedly more modern, more flexible cousins. The first one you'll hear about is Universal Life, or UL. The sales pitch for Universal Life is all about flexibility. Unlike whole life with its rigid premium, UL allows you to adjust how much you pay. You can pay more some years, less in others, and you can even adjust the death benefit. Sounds great, right? But this flexibility hides a ticking time bomb: the cost of insurance. Remember how we said permanent policies bundle insurance and savings? In a UL policy, that insurance cost is transparent, listed as a separate line item. And here's the terrifying part: that cost of insurance isn't level. It starts low when you're young and healthy, but it increases every single year as you get older. It skyrockets in your 60s, 70s, and 80s. The idea is that in the early years, your higher premium payments will build up enough cash value, and the interest earned on that cash value will be enough to cover the soaring cost of insurance in your later years. But what if it doesn't? What if the interest rates projected in the sales illustration don't materialize? What if you use that flexibility to pay the minimum premium for a few years? Suddenly, the rising cost of insurance starts eating your cash value like a monster. The policy enters a death spiral. You get a letter from the insurance company saying that to keep your policy active, you now have to pay thousands or even tens of thousands of dollars a year in premiums. Most people can't afford this, so the policy lapses. It collapses under its own weight, and you are left with nothing. Decades of payments all gone. You're now in your 70s, with no life insurance and no chance of qualifying for a new policy. It's a catastrophic failure, and it happens all the time. But wait, it gets even more complicated. If Universal Life isn't enticing enough, an agent might introduce you to its high-octane sibling, Variable Universal Life, or VUL. With a VUL policy, the cash value portion isn't sitting in a low-interest account. Instead, you get to invest it in a selection of sub-accounts, which are basically mutual funds. The pitch is irresistible. Why settle for 3% when you can get stock market returns inside your life insurance, all tax-deferred? This combines the high fees and soaring internal costs of a universal life policy with the full unadulterated risk of the stock market. If the market has a great year, your cash value might soar. But if the market crashes, your cash value gets hammered. Now, not only is the rising cost of insurance eating away at your policy, but your investment losses are draining it even faster. You can find yourself in a situation where you have to pour massive amounts of new money into the policy just to keep it from lapsing after a market downturn. It takes two completely separate financial concepts, pure insurance and pure investing, and smashes them together into a product that does neither one well. It's often the worst of both worlds. Finally, we arrive at the current superstar of the insurance sales world, Indexed Universal Life, or IUL. This is pitched as the magic bullet, the perfect solution with no downside. The sales pitch is, you get the upside potential of the stock market with none of the downside risk. Your cash value is linked to an index like the S&P 500. If the market goes up, you get credited interest. If the market goes down, you lose nothing. Zero is your hero. This sounds too good to be true, and it absolutely is. Here's how it really works. Your money isn't actually invested in the S&P 500. The insurance company is using complex option strategies to try and mirror the index's performance. And your potential gains are heavily restricted. They use a combination of 3 levers to limit how much you can actually earn. First is the cap rate. A cap might be set at, say, 9%. This means that even if the S&P 500 goes up 25% in a year, the most you can possibly be credited is 9%. Anything above that, the insurance company keeps. Second is the participation rate. This might be set at 80%. This means you only get to participate in 80% of the index's gains, up to the cap. So if the market goes up 10%, you're only credited with 8%. Third is the spread. This is a percentage that's simply subtracted from the index's return before you're credited anything. For example, with a 2% spread, if the market returns 7%, you only get 5%. Insurance companies can and do change these caps, rates, and spreads whenever they want. So that amazing 12% cap they showed you in the sales illustration could be lowered to 6% in a few years, gutting your future returns. And while they love to shout zero is your hero about down years, they whisper the other part. A 0% return doesn't mean you broke even. You still have all the policy fees, administrative charges, and that relentlessly increasing cost of insurance being deducted from your account. So in a flat or down year, a 0% return is actually a net loss. Your cash value goes down. The IUL is a masterpiece of financial engineering, designed to sound simple and safe while being incredibly complex, and tilted heavily in the favor of the insurance company. For the vast majority of Americans, these complex, high-fee permanent policies are not a pathway to wealth. They are a detour, a scenic route that costs you a fortune and often leads you right back to where you started, only much older, and with much less money than you should have. The simple, boring path: buy affordable term insurance to cover your temporary needs and invest the difference in low-cost index funds, remains the undisputed champion for building real, accessible wealth. And that simple, boring path is your ticket to freedom. It's the secret the insurance industry doesn't want to shout from the rooftops, because it's not where they make their biggest commissions. They make their money on complexity. They thrive when you feel like you need a secret decoder ring to understand your own finances. But you don't. The truth is, the most powerful financial strategies are almost always the simplest. Buy term, invest the difference. It's not flashy. It won't make for a great story at a cocktail party, but it works. It puts you in the driver's seat, separating the pure, low-cost protection of insurance from the powerful, wealth-building engine of your own investments. You control the investments. You have access to the cash. You get the full upside of the market, not just a sliver of it after a dozen fees are scraped off the top. So let's put this all together. After everything we've covered, what do you actually do? Right now, today, let's build your action plan. This is the culmination of everything we've learned. Step 1. Figure out your number. How much life insurance do you actually need? Don't just pull a number out of thin air. We can use a simple framework to get a realistic estimate. It's called the DIME formula. D is for debt. Add up all of your debts except for your mortgage. We'll get to that in a second. Think car loans, student loans, credit card debt, personal loans. The goal here is to wipe the slate clean for your family, so they aren't shackled to your past financial obligations. I is for income replacement. This is the big one. How many years of your income would your family need to maintain their standard of living if you were gone? A common rule of thumb is 10 to 12 years. So, if you make $80,000 a year, you're looking at $800,000 to about $1 million for this piece of the puzzle. This gives your spouse time to grieve without the immediate, crushing pressure of having to replace your paycheck overnight. It allows them to be a parent, not just a frantic bill payer. M is for mortgage. You want the house paid off. Period. This is often the largest single expense for a family. Removing it from the equation provides an incredible anchor of stability. Look at your current mortgage balance and add that entire amount to your total. And E is for education. If you have kids or plan to, you'll likely want to help them with college or trade school. College costs are astronomical. A safe estimate is to budget around $100,000 to $150,000 per child for a 4-year degree at a state university. Add up DIM&D. That's your number. It might seem huge. It might be 1 million, 2 million, or more. Don't panic. That number is the goal. It's the fortress of security you're building. And the cost to build it is going to be far, far less than you think. Step 2. Determine your term length. For how long do you need this fortress to stand? Remember, life insurance is for covering temporary needs. The goal is to become self-insured. So, you want a term length that gets you to that finish line. For most people, that's when the kids are grown and financially independent, and the house is paid off. A 20-year or 30-year term is perfect for the vast majority of families. If your youngest child is 2, a 20-year term will see them through college. If you just bought a house on a 30-year mortgage, a 30-year term makes perfect sense. Don't overcomplicate it. Align the term with your biggest financial obligations. Step 3. Shop around. This is non-negotiable. Do not just go to the company that insures your car. Do not just call the agent your parents used. Life insurance pricing is intensely competitive, and different companies specialize in different health profiles. Some companies are more lenient on weight, others on family health history, others on things like a past speeding ticket. Using an independent online broker like Policy Genius or Xander Insurance is a fantastic way to compare dozens of quotes from top-rated companies all at once, for free. They don't work for one insurance company. They work for you. This single step can save you hundreds, if not thousands of dollars over the life of your policy for the exact same coverage. Step 4. Apply and take the medical exam. The application will ask you detailed questions about your health, your family's health history, your lifestyle, and your finances. Be ruthlessly honest. If you smoke, say you smoke. If you have a health condition, disclose it. Lying on a life insurance application is fraud, and it's the easiest way to have a future claim denied, leaving your family with absolutely nothing. The insurance company will pull your medical records, prescription history, and motor vehicle report. They will find out. Honesty is your only option. The medical exam is simple and free. A technician comes to your home or office, takes your height and weight, a blood pressure reading, and a blood and urine sample. That's usually it. It's not a stress test. They're just getting a baseline of your health to confirm the information you provided. For some levels of coverage, especially if you're young and healthy, some companies are even waiving the medical exam entirely now. Step 5. Review your policy and make the first payment. Once you're approved, the company will send you the physical policy. Your rate is now locked in for the entire term. A 30-year-old male who gets a $1 million, 30-year term policy for $60 a month will still be paying $60 a month when he's 59. Read the policy to make sure the coverage amount and term length are correct. Sign the delivery receipt, make your first premium payment, and you are officially covered. You've done it. You have built the fortress. And that's the process. It's not a mystical quest. It's a series of simple logical steps. But I know what some of you might be thinking. I'm young. I'm healthy. I'll get it later. That is the single most expensive mistake you can make. You don't buy life insurance with money. You buy it with your health. The younger and healthier you are, the dirt cheap it is. You are locking in your insurability for decades. If you wait until you have a health scare, it could become astronomically expensive, or you may not be able to get it at all. Others might be thinking, I can't afford it. Can you afford a cup of coffee from Starbucks? Because for most healthy 30-somethings, a robust term life policy costs less than a daily latte. We're talking about $50, $60, maybe $70 a month to provide $1 million safety net for your family. The question isn't whether you can afford to have it. It's whether your family can afford for you not to have it. We've spent all this time talking about policies, numbers, and strategies. But let's zoom out for a moment and talk about what this is really all about. Life insurance is not about you. You will never see a dime from it. It has nothing to do with your death. It has everything to do with their life. It's a love letter written in the language of financial certainty. It's the final bill you pay. It's the ultimate act of responsibility that says to your family, my greatest fear is not what might happen to me. It's what might happen to you if I'm not here. And I will not let you face that alone. It's the mortgage payment being made when you can't make it. It's the lights staying on. It's the college tuition being paid. It's the promise that a tragedy doesn't have to become a catastrophe. It's the gift of time. The time for your loved ones to grieve and heal without the crushing weight of financial ruin. It's the ability for your partner to be a grieving parent, not a single parent forced to work 3 jobs. Getting life insurance is one of the most profoundly selfless things you can do. It's you today taking 30 minutes out of your life to protect their entire future. It's trading a small, predictable monthly payment for their absolute peace of mind. So your task is not to go buy a policy tomorrow. Your task is simpler. Tonight, take 15 minutes. Use the DIME formula. Figure out your number. Take that first crucial step from the abstract into the concrete. Because knowledge is only potential power. Action is where real power lies. You now know more about this topic than 99% of the population. Use that knowledge. Protect your family. Build your wealth. Take control of your financial future. Because life insurance isn't fundamentally about planning for an end. It's about ensuring that the life you've built, and the people you love, can continue on no matter what. It's for life.